Hi, everyone. My name is Jacob Stevens, and I'm an attorney in Husch Blackwell's tax group. Thank you for joining for part 2 of our Inflation Reduction Act webinar series about the energy provisions therein. Before we begin, I'd like to go over a few housekeeping items. At the bottom of your audience console, there are multiple application icons for your use during the program today. If you have any questions during the webcast, please submit via the question box. We will try to answer all questions during the webcast today, but if a fuller answer is needed, or if we run out of time, it will be answered later via email. A quick note from part 1 of our series, we have those questions and answers posted in the program materials folder, so you can download that and take a look. Also in that program materials folder is a PDF of today's presentation, if you'd like to download that. This program has been approved for legal education hours. To report your hours, click on the CEU icon at the bottom of the screen. A certificate of attendance, including course numbers, will be emailed to you tomorrow morning, along with a recording of the webcast for watching and sharing. Toward the end of the program, be sure to complete our short survey. We use your feedback to plan future programs that are applicable to your business needs. Presenting today is Doug Jones. Doug's deep experience in tax law includes practical strategies for clients regarding mergers, acquisitions, joint ventures, workouts in and out of bankruptcy, recapitalizations, divestitures, spinoffs, entity formations, as well as all forms of capital raising activities. After Doug's presentation, we will also be addressing live audience questions with Jason Reshley, who counsels on issues relating to reorganizations, purchases, divestitures, sales of business assets, and tax considerations, including tax credits with respect to financings. That is all for our housekeeping items. Doug, take it away.
Thank you, Jacob. Welcome, everybody. Thank you for joining us on this, the second of our webinars covering the Inflation Reduction Act. And we will dive right in. First, we're going to do a high-level overview of the IRA and its provisions. As we mentioned, this is a three-part webinar, so if any of the topics that we cover very high level on this slide are of interest to you, you can go back and see and rewatch the recorded webinar number 1. The IRA extended and modified the existing ITC under Section 45 and PTC under Section 48, and additionally created new clean energy ITC and PTC credits. One of the biggest changes is that the IRA creates a 2-tier credit system with a lower base credit amount and then a credit amount that is 5 times the base amount if prevailing wage and apprenticeship requirements are met. In addition, there are additional adders for additional credit amounts for ensuring that eligible facilities and property utilize domestically produced steel, iron, and manufactured products. For locating in energy communities, which are generally brownfield sites and census tracts with historical coal or oil and gas employment or production. And certain low-income communities can also, if your project is located in certain low-income communities, certain of the credits will receive an additional adder. Another big change is how these credits can be monetized. Prior to the IRA, all the credits were non-refundable credits, which led to the development of tax equity financings, which allowed developers who did not have tax liability large enough to use all the credits to monetize them, because if they were non-refundable, the developers would only be able to use the credit up to their tax liability, and then the rest would not be utilized. The tax equity structures address this, but now we have other options because of the IRA. We have direct pay and we have transferability. Now, these represent a big change in how credits can be monetized. Direct pay is a election to treat the credit amount as a deemed payment of tax, and if there is extra credit amount after the tax liability has been soaked up, a refundable payment, a tax refund payment will be made by the government to the person electing direct pay. Transfer is another option that was created by the IRA, and this allows someone who is eligible for a credit to elect to basically sell the credit for cash. So two options, which increase the ways in which people can monetize these credits. And you know, there's been a lot of questions and discussions about, well, what impact are these new features going to have on tax equity? And a lot of people think that really traditional tax equity is not really going to go away, but these are going to be other options. Direct pay and transferability are going to be other options for people to consider for monetizing the credits. In addition, neither direct pay nor transferability, since they only transfer credits or make an election to treat a credit amount as a deemed payment of tax, neither of those mechanisms are going to help you monetize depreciation. So that's a reason why people think tax equity will stick around. And also because for ITC purposes, tax equity structures also have built in a way to increase, to step up the basis of the facility, of the facility, and which is a good thing because that's what the ITC is calculated based on. So these are all topics that are covered in webinar 1. If they are interesting to you, I invite you to go on the website and rewatch webinar 1 if you've not already done it. Topics for webinar 3 will include the advanced manufacturing credit, nuclear credits, tax benefits for electric vehicles, and we may also be covering tariff and supply chain issues in that webinar as well. So we can now dive right into our first big topic, which is carbon capture. So new section 45Q covers carbon capture use and sequestration, or CCUS. The IRA extended the start of construction deadline to December 31 of 2032. So there's a lot more time now to begin construction on carbon capture facilities. The IRA also modified the amount of carbon that a facility will need to capture in order to qualify. It is now 100 metric tons annually for direct air capture, which is a technology that will just capture carbon directly from the air. It is not, bolted onto a electricity generating facility or some other industrial process. You need to have 18,750 metric tons annually for electricity generating facilities. And there are some rules about exactly kind of how efficient the carbon capture equipment needs to be in order to qualify with respect to electricity generating facilities. And then for any other facility, the limitation, the threshold is 12,500 metric tons annually. The IRA sets the base credit amount at $17 per metric ton for geological sequestration, and a lower base credit amount of $12 per metric ton for carbon oxide that is reused or utilized. These amounts are increased 5 times to $85 and $60 respectively if the facility meets prevailing wage and apprenticeship requirements for the first 12 years of operation. So that is a long time to be testing whether the wage and apprenticeship requirements have been met. And it really reinforces and stresses the importance of making sure, being very carefully that these wage and apprenticeship requirements, which were covered in detail in the first webinar, since that period is so long, it incentivizes people to make very sure that the requirements are met and will be met throughout the entirety of that 12-year period. And we will talk about the difference between sequestration and utilization in a minute, but note, of course, that the credit amounts are higher for sequestration rather than utilization. The base credit, there's also a base credit rate for direct air capture. And if carbon that is captured through direct air capture is geologically sequestered. The base rate is $36 per metric ton. And if carbon that is captured through direct air capture is utilized in a qualifying manner, it's 26. And these amounts increase to 180 and 130 if the project meets the prevailing wage and apprenticeship requirements. Many of these credits have a feature. Many of the credits introduced by the IRA or modified by them have a feature where if the facility in question was financed by tax-exempt bonds, there is a proportional reduction in the amount of credit rate that is available, and carbon capture and Section 45Q are no different. The IRA modified 45Q to provide some flexibility on the period for which credit can be claimed in the event of a federally declared natural disaster affecting the project. So a tolling effectively, which will allow you to extend the period where the credit can be claimed if the project is affected by a natural disaster. Interestingly, 45Q and the carbon capture credit is one of only 3 credits for which non-tax exempt entities are eligible to claim direct pay. So it's, you know, as with direct pay generally, when thinking about direct pay in sort of the carbon capture 45Q space, you know, the impact on the tax equity market is kind of remains to be seen. But a lot of people think that this is just going to be another option. It's not necessarily going to drive tax equity out of business. Some sponsors may choose not to pursue tax equity, and some may choose to pursue that route, again, because you have, it's a way to monetize depreciation in addition to the credit. Direct pay, if elected, is available for the first 5 years of a facility's operations. And one big unknown, which is going to be an important thing to consider if you're one of these people who's considering, okay, is direct pay right for me? Is, you know, tax equity right for me? Is that the time frame for which direct pay payments will be made is kind of up in the air at the moment. Direct pay will be elected as an initial matter when a taxpayer files a return for a year in which a credit is determined. And the statute gives Treasury wide latitude to, quote, require such information or registrations as the Secretary deems necessary. So, you know, one thing that's unknown is, okay, after you get your return in, how long is it going to take the government to get you your money? And that's kind of unclear at the moment. And it may be a stumbling block for some people who are used to tax equity and are kind of know how those structures work and know when the sort of payments are coming in. In addition, another question mark here is we don't really know what the form of the election is going to take. I think a lot of people are hoping it's going to be relatively simple, but it could be pretty involved. It authorizes Treasury to require registrations if the Secretary deems it necessary. So there could be a significant administrative sort of process that comes along with electing direct pay for carbon capture. One of the things that we know about for 45Q is kind of how the attribution rules work. So in the case of carbon oxide captured by carbon capture equipment that was placed in service on or after February 9, 2018, that's the effective date of the Bipartisan Budget Act 2018. So if you place in service your equipment after that February 9th, 2018 date, the credit is attributable to the person that owns the carbon capture equipment, and then either physically or contractually ensures the capture and disposal or utilization of the carbon oxide. So ownership and ensuring the use or sequestration, either physically or contractually. Contrast this with equipment placed in service before February 9th of 2018, and you see that the credit is attributable to the person who captures and physically or contractually ensures capture and disposal of capture and capture, disposal, or utilization of the carbon. And there's no consideration as to who owns the equipment with respect to equipment placed in service before that deadline. There are also recapture rules, as there are with many of these credits. The regulations provide for recapture of credits. It should be noted 45Q existed prior to the IRA. It was modified by it. So there are regulations on 45Q. There are other sort of administrative issuances of guidance. And there are existing regulations for 45Q. And they provide for some of the recapture rules. And the recapture period is 3 years. It lasts for 3 years after the claim of credit. And recapture is only deemed to occur when, in any given year, the amount of carbon that leaks is greater than the amount that has been sequestered. And there's also a helpful exception to recapture rules for leaks unrelated to operations, such as natural disasters, terrorism, that kind of thing. Now, sequestration is just capturing the carbon and storing it securely underground in some kind of geological feature, salt domes, old oil and gas wells, things of that nature. Utilization, however, is another way that you can use the carbon that has been captured and qualify for the credit. And the statute tells us that utilization means the fixation of carbon oxide through photosynthesis or chemosynthesis, for example, the growing of algae or bacteria, the chemical conversion of such qualified carbon oxide to a material or chemical compound in which such carbon oxide is securely stored, and most broadly, the use of carbon oxide for any other purpose for which a commercial market exists. That last clause there is quite broad, and there is a requirement that a taxpayer claiming a credit for utilization in that category must substantiate the existence of the commercial market. So what is a commercial market then? A commercial market means a market in which a product, process, or service that utilizes carbon oxide is sold or transacted on commercial terms. So again, that's a very kind of broad definition of what a commercial market is. And then when it comes to measuring the carbon that has been utilized, because you only get a credit for the carbon that has been utilized, the amount utilized is the metric tons of carbon oxide, which based on a life cycle greenhouse gas emission analysis are captured and permanently isolated from the atmosphere or are displaced from being admitted into the atmosphere. So it's a life cycle analysis, or LCA, that will be performed by independent experts like environmental or consulting firms. And the LCA is going to have to be submitted to the IRS or Department of Energy. 45Q also contains its own special transferability provisions. We have the transferability provisions, which are generally applicable to most of the credits. But 45Q has its own one. It's found in 45Q F3, and it allows a taxpayer that owns carbon capture equipment to make an election to transfer the credit to the taxpayer that disposes of or uses the carbon oxide. So the person who owns the equipment can transfer the credit to the person who owns the sequestration well. The election can be all or for part of the taxpayer's credit. The credit can be transferred to more than one party, but the credit must be transferred to the person contracting with the owner, not subcontractors. To give people some, to get their kind of brains firing on ways in which, common sources for carbon capture. Here's a few. You have coal-fired plants, natural gas-fired plants, ammonia and fertilizer plants, ethanol plants, which are interesting because prior to the IRA increasing the credit rate, the only, as far as I'm aware anyway, the only carbon capture projects, or at least most of them, that were being done or planned were with respect to ethanol plants, because apparently, and I'm not an engineer, but apparently the carbon output from such ethanol plants is very pure, and then it's easier for the technology to pull more carbon out. But then there's also petrochemical plants, liquid natural gas trains, industrial processes like cement and steel, and even direct air capture. As I said, we do have some rulings on carbon capture, and one of them we're going to discuss here quickly, which is Revenue Ruling 2021-13. And this deals with third-party investors investing in carbon capture equipment at a pre-existing facility that already contained equipment that separated and emitted carbon dioxide. So it was a pre-existing facility. It had equipment which could pull carbon dioxide out and then they would just kind of vent it into the atmosphere. This ruling described the installation of additional carbon capture equipment by a third-party investor in 2021 at an operational methanol facility. And that facility contained an acid gas removal unit that was placed in service back in 2017. And this acid gas removal unit was the equipment that separated and then vented the carbon dioxide. So this ruling gave us a couple of rulings. The first is that the acid gas removal unit is considered to be carbon capture equipment within the meaning of 45Q. The second ruling is that the third-party investor is not required to own every component of carbon capture equipment within a single process train at the facility in order to be the person to whom the 45Q credit is attributable. They only have to own one, or they're not required to own all of them. And the third ruling we got relates to the dates of originally being placed in service, which are important because when something is placed in service will often have an impact on the amount of credit that it is available for that, or with respect to that equipment. So the third ruling is that solely for purposes of Section 45Q, the original placed in service date of a single process train of carbon capture equipment is the date that the single process train is placed in a condition or state of readiness and availability for the capture, processing, and preparation of carbon dioxide for transport, injection, or utilization. So it's a lot of words. What it means is that the original placed in service date is 2021 for purposes of the credit. And that is prior to the third-party investor adding the additional carbon capture equipment, the acid gas removal unit merely separated and vented the carbon dioxide. It wasn't until the additional equipment was added that the single process train was able to capture carbon dioxide and prepare it for transportation or storage or utilization. Once that single process train was able to accomplish, or was placed in a state of readiness and availability to accomplish the actual storage and utilization of the carbon rather than venting it into the atmosphere, that's the date for purposes of the carbon capture credit that is considered placed in service, because that's the date that you can start actually capturing carbon. And then a fourth ruling was that the original placed in service date for the single process train for purposes of the 45Q credit does not affect the placed in service date for the acid gas removal unit or the new equipment for depreciation purposes. So they will continue to depreciate based on the placed in service date of 2017, and then for purposes of calculating the 45Q credit, the placed in service date was in 2021 when the third party investor added the new equipment. So, skipping over now to the clean hydrogen production tax credit and Section 45V. This is a new credit for qualified clean hydrogen produced at a qualifying facility during the first 10 years of the facility's operation. The base rate of the credit is 60 cents per kilogram, multiplied by the applicable percentage, which ranges from 100% to 20%, depending on the life cycle greenhouse gas emission rate related to the hydrogen. So obviously hydrogen is a clean burning fuel, but it takes energy to produce. And you get more credit if you use a clean energy source than you would if your source is more carbon intensive. Like many of the other credits in the IRA, the credit increases 5 times from the base credit if prevailing wage and apprenticeship requirements are met, but no enhancements are available to the hydrogen credit for domestic content or for energy communities. And as with many of the other credits, if the facility is financed by tax-exempt bonds, there will be a proportional reduction in the amount of credit. And the hydrogen also must be produced in the United States or a possession thereof, and in the course of a taxpayer's trade or business, and it must be sold or used. The beginning of construction of a hydrogen facility is required to occur before January 1, 2033. And a concept similar to the revenue ruling that we discussed on carbon capture exists here. Facilities existing prior to January 1 of 2023 will qualify based on the date that modifications to the facility required to produce clean hydrogen are placed into service. Taxpayers can elect to claim the PTC for electricity produced from renewable resources if the electricity is used at the qualified clean hydrogen facility to produce qualified clean hydrogen. So you can have a solar or wind operation powering a hydrogen production operation, and you can get if it's wind, you can get PTC for the electricity produced. Then you would also get a credit for the hydrogen that's produced. And there is also an election to receive an ITC instead of the clean hydrogen production credit, which is available. Taxpayers may not claim the credit for clean hydrogen if it is produced at a facility that also claims the carbon capture credit under 45Q. Clean hydrogen is an interesting credit also because it is one of the 3 that non-tax exempt taxpayers can elect direct pay for. Those 3 are hydrogen, carbon capture, and the advanced manufacturing credit. And those 3 can be claimed by anyone, regardless of whether they're tax exempt or not. And then many of the other credits are then only available to claim for direct pay if you have a tax exempt entity or a governmental native corporation, a Tennessee Valley Association, or a co-op. The statute requires the secretary to come out with guidance within 1 year of the date of enactment, including with respect to determining how the life cycle greenhouse gas emissions kind of testing is going to work. So now transitioning a bit to some of the alternative fuels and credits for them that are also in the IRA. There is also tax credits for alternative fuels, alternative fuel mixtures, biodiesel, renewable diesel, and second generation biofuels. And these have all, the credits for all of these has been extended to December 31, 2024. This will apply to the 50-cent per gallon tax credit for alternative fuels and alternative fuel mixtures. And this is a credit that expired at the end of 2021, and it has now been retroactively extended to the through 24. It also applies to the $1 per gallon tax credit for biodiesel and renewable diesel, which would have expired at the end of 2022. The biodiesel and renewable diesel mixtures tax credit may be claimed as an immediate excise tax credit against the blender's motor and aviation fuels excise tax. And credits in excess of this excise tax liability can be refunded. The biodiesel and small agri biodiesel credits may additionally or alternatively be claimed as income tax credits. Just today, we talked about how these credits, the extension of these credits is retroactive because some of them expired at the end of 2021. The statute provided that certain of these, because of this retroactive nature, the IRS would have to create a process for retroactively claiming these credits, where this guidance would provide for a 180-day period for the submission of such retroactive claims to begin not later than 30 days after guidance is issued. Such claims will be paid within 60 days, or if not, will accrue interest after 60 days. About 20 minutes before coming down to do this presentation, I saw that the IRS has released Notice 22-39, which addresses exactly these retroactive claiming procedures. So if that is something you're interested in, check out Notice 2022-39. Sustainable aviation fuel credit is a new credit for the sale or mixture of sustainable aviation fuel, and it begins in 2023. The credit has a base amount of $1.25 with certain increases if the life cycle greenhouse gas emission reduction percentage for the fuel exceeds 50%. So up to a maximum of $1.75 per gallon. So the cleaner it is, the cleaner your process is, the more credit you will get. And sustainable aviation fuel is defined as fuel that meets certain industry standards, is not derived from co-processing an applicable material with a feedstock that is not biomass. We're going to talk about exactly what biomass is in a minute. And is not derived from palm fatty acid distillates or petroleum. And finally, has been certified to achieve a certain level of greenhouse gas reduction as compared to petroleum-based jet fuel. This credit will require registration with respect to with the Secretary of Treasury. And this credit can be used to offset excise tax liability or taken as a direct payment in the event of an insufficient excise tax liability, and can also alternatively be taken as an income tax credit. Credit amounts are included in a taxpayer's gross income for income tax purposes, and the credit expires at December 31, 2024. And you may be thinking to yourself, well, gosh, that's not a lot of time. 2024 is only a couple years away. And the reason there isn't a ton of time for it is because 45Z is going to come and replace a lot of the existing alternative fuel credits, which will be all of them phasing out beginning 2025. Thereafter, the 45Z clean fuel production credit will kick in. And this, by the way, is a similar concept to what happened with the ITC and the PTC. Current ITC and PTC were extended for a couple of years. And then new clean energy, zero emission investment credits and production credits were enacted to become applicable upon the ITC, the current ITC and PTC expiring. Now, the credit per gallon of transportation fuel under 45Z equals the product of an applicable amount times a relevant emission factor. The applicable amount for non-aviation fuel ranges from 20 cents to $1, and for non-aviation fuel, and from 32 cents to $1.75 for aviation fuel. And again, if you're meeting the prevailing wage and apprenticeship requirements, that's how you increase to the higher amount beyond the base amount of the credit. Qualifying fuel will be produced and sold by the taxpayer at a qualified facility not including facilities that receive credits for clean hydrogen, carbon oxide sequestration, or the investment credit for energy produced in clean hydrogen facilities. Additionally, under 45Z, qualified producers must be registered with the IRS. And even though we covered ITCs in the last webinar, since we are covering alternative fuels in this one, we thought it would make sense to quickly discuss the expansion of the ITC to cover biogas property. So the IRA expanded the definition of energy property for purposes of the ITC to include qualified biogas property. So what is that? Section 48C7 defines qualified biogas property as property comprising a system which converts biomass into a gas. And then the gas has to consist of not less than 52% methane by volume, or must be concentrated by such system into a gas meeting such minimum methane content requirements. Such system must also capture gas for productive use and not for disposal via combustion. And biogas property includes any property which is part of such system which cleans or conditions such gas. And it's going to be limited to property that begins construction on or before December 31, 2024. Finally, biomass is defined in section 45K(c)(3) as any organic material other than oil and natural gas or any product thereof, and other than coal or any product thereof. So that is the scope of what we have to discuss on the slides today. We wanted to leave some time for questions, and now it's time for that. And I'm seeing that we haven't got any questions come through in the chat.
We can broaden out and cover any other questions that you may have on the IRA in addition.
Correct. Yeah. So really, anything our audience would like to know, we can take a stab at. You can just submit questions in the chat. We'll give it a couple of minutes, and if there aren't any, we'll give people some extra time back in their day. Okay, well, we're not seeing any questions come through, so I would invite the audience. Oh, there are 3 questions. Okay.
So the direct pay. So why don't we go to the first question? What's the first?
Yes. Okay, so here we go. Discuss utilization of CO2 when the CO2 is sold for commercial use, like food processing. So that's right. So carbon that is captured and not sequestered can be utilized in a variety of ways that it uses for carbon that exist in the marketplace. So it could be used for food processing, could be used for dry ice, could be used for any number of industrial processes. And the idea is that if we can use the carbon that's been captured and, we'll be, on a net basis, reducing the amount that is released into the atmosphere. So yeah, the utilization requirement that you utilize it for something that a commercial market exists is very broad. So, if carbon can be bought or sold and used in some productive fashion, chances are it'll be considered a good utilization. Question number 2, I'll turn this one to the whole group. Any idea on when IRS guidance on the IRA will be coming out?
I don't know what the timing is, but I think if you look at it, if they're planning to do it through reg projects, it's going to take a while for that to get put together. So I would expect it's probably 6 months or something like that. They could pick isolated topics to do it. Generally in legislation like this, they tend to prioritize the items that have the most immediacy of getting of taxpayer compliance. And so some of the major provisions that need guidance aren't technically applicable until 2023. And so I think you're going to see that impact on the timing of doing things.
Yeah. Like we got today the notice that deals with how to retroactively claim the alternative fuels credits for the ones that expired at the end of 2021, at least with respect to some quarters of 2022. So, right, that, things may come out in drips and drabs, and then the big reg projects, thank you, Jason, I agree, would take a little time. Let's see, in our third, okay, we got some more questions coming in now. Here we go. Is direct pay mandatory during the first 5 years, or can it be elected every year for the 12 years until 5 direct pay terms are used? So when you make the election, there is a deemed, the election is deemed to be made for the year it's made in and 4 succeeding years. And then after those 5 years, direct pay is not available. It's only for those first 5 years. Anything to add to that, guys?
I mean, there is an exception that they can elect to revoke the application made, but there's limitations on doing that. So my guess is, in large part, if you elect direct pay, you're sort of tied in, subject to those limitations.
So we have a question here, which I'm not sure we're going to know the answer to, but it's an interesting question. How would you define use within clean hydrogen, the clean hydrogen PTC? For example, producing hydrogen to burn into a cogen would qualify or not? My understanding of the credit is that it would apply to, hydrogen that is sold or used. So based on that language in the statute, that leads me to believe that or using it for cogeneration would qualify. But, as with all of this stuff, guidance is coming. So, that may be subject to some modification once that guidance comes out. Here's one I'll turn over to the group. Do you see any provisions that could apply to existing facilities pre-22?
I mean, these provisions in large part have been drafted as being applicable to assets placed in service after a specified date. And so largely that's what they're going to apply to. So it's tied more to a placed in service element as opposed to some other concepts. I mean, some of the qualifications were based upon beginning of construction. And I think if you talk about beginning of construction, assuming the IRS does not try and gin up a different definition of beginning of construction, it does have some impact as to whether you're going to be subject to the prevailing wage rules and apprenticeship rules, because you will have begun before that date.
Right. And then at least with respect to the carbon capture credit and the hydrogen credit, there are specific provisions and guidance out there. We discussed the revenue ruling in the carbon capture area, where a third-party investor added carbon capture equipment onto an existing facility and could still qualify for the credit. A similar concept exists with respect to hydrogen, because I think people are expecting that if you have an existing solar or wind operation and you put hydrogen production kind of in conjunction with that other operation, you know, the 45V, I believe it is, for hydrogen will say that you know, you can you can add the hydrogen equipment onto the existing facility and qualify for the hydrogen credit. So yeah, there are those sorts of concepts out there as well. Last question we have is, does CO2 produced at ethanol facilities used for beverages qualify for the credits? That is absolutely using carbon dioxide to carbonate beverages is absolutely a commercial use. All right, well, ladies and gentlemen, we have gone through questions that we have. If you've got one, you've got another minute or so to get it in and we will cover it. If not, we are going to wrap up and give you all a little bit extra time back in your day. Thank you very much for joining us. Jacob, you want to close us out?
Sure. Thank you again for joining. We hope that the webinar was helpful for you and your organization. As a reminder, this program has been approved for legal education hours. So to report your hours, just click on the CEU icon at the bottom of your screen. A certificate of attendance will be emailed to you tomorrow along with a recording. And please be sure to complete our short survey. We use the feedback to help with our future presentations. This concludes our webinar. Thank you all so much.